Fundsupermart.com.
What is your outlook for both equity and fixed income markets for 2013?
It's going to be remarkably similar to last year, we think. We're going to start off with some good news. We're going to see the cold winds coming in at some point during the year, and then it wouldn't surprise us to see a very strong end of the year. Because even though we're getting good news now, we're not actually out of the woods yet. Now within that, wouldn't surprise me to see both bonds and high yields come in with similar returns as they did last year, but with the high yields, of course, having much higher volatility. So in short, I think it's going to be it's a pretty good year. I think probably equities could break out again this year, but again, it's going to be with high volatility. So pretty good year, but lots of volatility.
Are there any macroeconomic trends that you'll be watching out for in 2013?
Yes, absolutely. The markets at the moment are still very artificial, and they're artificial because the Fed, of course, is pumping in so much money. Now, at some point, that's going to come to an end. Now, the Fed has already hinted it's going to be roundabout when unemployment reaches or falls to 6.5%. Now, on our figures, that won't be this year, but clearly we've got to be watching that, because once that turns and the Fed stops pumping money into the system, then the whole game plan changes. Now, apart from that, I think what I'm personally focusing on is going to be China. And I say China because there's an awful lot happening in China. There's a lot of unknowns still. People still don't really understand the data coming out of China. It's very opaque. And on top of all of the economic data, there's also margin compression occurring with Chinese companies. So clearly, there's a lot of room yet for analysis on what's happening in China. In contrast, in the US and in Europe, we've analysed the data to death. You know, if somebody leaves the euro, who's going to be surprised? If the US slips back into recession again, who's going to be surprised? Not many surprises there. So for me personally, I'm going to be focusing very much on China and of course the flow out of that through Asia itself.
Within equity markets, what sectors or geographical regions are you most positive or negative on?
Well, we're a bottom-up house. So we tend not to look at markets and we look at and then sectors and then companies. We tend to start off with the companies. Now, having said that, you can still spot tremendous value in the markets that people don't want to touch. Germany, for example, Italy, for example. There's good value in Japan, although, of course, people are starting to focus on that. There's also good value in China, and there's selected good value elsewhere across Asia. So to us, it's not a matter of really the market or the sector, it's where that value is found. Now, having said that, we could see quite a change in the next year, because in 2012, everybody was chasing safety, and the stocks that were safe have now become very expensive. Whereas the so-called risky stocks, the cyclical stocks, are starting to look really cheap. And a number of our funds are moving towards those cyclicals. Now, the cyclicals might be consumer durables or consumer cyclicals, for example, in China. It could even be metals and mining stocks. So to me, the best value now is actually in some of these cyclicals, and this is one reason why we're saying to people, even though we think bonds are still going to have a reasonably good year, maybe now is the time to be adding some risk to your portfolio and positioning yourself in some of these very cheap cyclical stocks.
While fixed income has enjoyed a relatively good year in 2012, some investors are worried about yield compressions and a possible bond bubble. What are your thoughts on this issue, and which fixed income segment do you see the best risk-return potential?
Well, it all comes down to the Fed, and it's just that simple. If the Fed sticks with its 6.5% unemployment target, then just extrapolating down the rate at which unemployment is falling at the moment, that would indicate that they would stop and reverse their easy money policy round about the middle of next year. Now, if that's the case, then we've still got another bull market in bonds ahead of us. To the extent that while a lot of people say, look, US Treasuries are very expensive, it wouldn't surprise me under these conditions to actually see US Treasuries yields nudge down even a little bit further. But I think what's going to happen is that as that's yield compression that is occurring because of the Fed, it's spreading out into the food chain. And so you've had high investment grade yields suddenly going lower. And then you suddenly get the high yields suddenly going lower. And then you get the Asians suddenly going lower. And then you get the Asian high yields suddenly starting to go lower. And of course, that's what we're seeing at the beginning of this year. So I think, yes, it could be, and it probably is, a bond bubble. But I don't think it's the end of the game yet. And it wouldn't surprise me to see another quite strong compression in credit spreads, particularly in the higher yielding end of the curve. So coming to the point, would I be a buyer of high yields? Yes, I would. Would I be a buyer of Asian high yields and Asian bonds generally per se? Yes, I would.
Thank you.